You have $50,000 in savings, and it's actually losing you money. That number might sound safe, comfortable, but it's a quiet trap because $50,000 in a standard savings account today buys you less every single year. Inflation eats it alone, and you're told to just keep saving. That advice is dangerous. Most people never learn the switch. The moment you stop being a saver and become an investor, it's not about more money, it's about a different mindset. A shift from preserving to growing, from safety to smart risk. Here's the hard truth. Savings is for emergencies. Investing is for building wealth. They serve two completely different jobs. Mix them up, and you either lose your safety net or miss your chance to grow. The first step is knowing the difference. Step 1. Build your foundation. Before you invest a single dollar, you need a cash cushion. Most experts say 3 to 6 months of expenses. That's your shield. Without it, any market dip could force you to sell at a loss. Protect yourself first. Once that cushion is in place, you can finally move. But don't just throw money at the market. You need a plan, a simple one. The kind that ignores daily noise and focuses on decades, not days. That's where real returns live. The single most powerful tool you have is compound interest. Einstein reportedly called it the eighth wonder of the world. It's not magic, it's math. Your money earns money, that new money earns money too. Over time, it snowballs into something huge. But here's where most people stumble. They try to pick winning stocks. They chase hot tips. They trade constantly. That's not investing. That's gambling. And the house always wins. The real trick is boring, and that's exactly why it works. The boring secret is low-cost index funds. They track the entire market. You don't have to pick winners. You own everything. Over time, the market goes up. Not every year, but over decades, it trends upward, and you capture that growth. Let's look at a real example. The S&P 500 has returned roughly 10% annually on average over the last century. That includes crashes, wars, and pandemics. If you had invested $10,000 in 1990, it would be worth over $150,000 today. No picking stocks, no timing. But you can't just buy once and forget it. You need a system. Automatic contributions every month, no matter what the market is doing. When it crashes, you buy more shares for cheap. When it booms, your existing shares grow. Consistency beats timing. This is called dollar-cost averaging. It removes emotion from the equation. You don't have to predict anything. You just keep buying. Over time, your average cost per share becomes lower than the market's average price. That's a mathematical edge. Now, let's talk about the enemy. Fees. A 1% annual fee might not sound like much, but over 30 years, it eats roughly 30% of your total returns. That's not hyperbole, it's math. Choose low-cost funds. Vanguard and similar providers offer them at near zero. You also need to know your risk tolerance. Are you 25 or 55? That changes everything. Young investors can afford to take more risk. They have decades to recover from a crash. Older investors need more stability. Bonds become your friend. A simple rule: 100 minus your age is the percentage to put in stocks, the rest in bonds. At 30, that's 70% stocks, 30% bonds. At 50, it's 50-50. It's not perfect, but it's a good starting point. You can adjust as you learn more. But don't just blindly follow rules. Understand why you're investing. Are you saving for retirement in 30 years? A house in 5? That changes your strategy. Short-term goals need less risk. Long-term goals can ride out the volatility. Match your timeline. One more trap: Panic selling. When the market drops 20%, fear takes over. You sell to stop the pain, but you lock in the loss, and you miss the recovery. The market always bounces back eventually. Those who stay calm get rewarded. The best investors are not the smartest. They are the most disciplined. They have a plan. They stick to it. They ignore the news. They ignore the noise. They just keep buying, month after month, decade after decade. That's the whole game. Now, let's talk about taxes. Investing in a regular brokerage account means you pay taxes on gains. But if you use a tax-advantaged account like a 401k or IRA, you defer or avoid those taxes. That gives you a huge head start. Max out your employer match first. That's free money. Then go for a Roth IRA if you qualify. Then back to your 401k. This order maximizes your returns and minimizes taxes. It's the most efficient path to wealth for most people. You are now ready. You have the cushion, the plan, the tools. You understand compound interest, dollar cost averaging, and the power of low fees. The only thing left is to start. Not tomorrow, not next month. Today. The best time to plant a tree was 20 years ago. The second best is now. That's the blueprint. From saver to investor. It's not complicated, but it requires action. The first step is always the hardest. But you just took it. You have the blueprint. But execution is everything. Most people freeze right here. They read the plan, then they do nothing. Don't be that person. Start with one small step. Open a brokerage account today. It takes 10 minutes. Choose a platform with low fees. Vanguard or Fidelity are solid. Transfer a small amount. Even $50 works. This is your first real move. Now buy your first index fund. Don't overthink it. Pick something like VOO or VTI. One click and you're in. The market isn't a casino, it's a wealth-building machine. But you must be inside to win. Here's a mistake most rookies make. They check their portfolio every day. That's dangerous. Short-term noise makes you anxious. Set a schedule. Review once a quarter, then go live your life. Real wealth needs time. Decades, not days. Consider this. The best performing investor in history? A dead one. Because they held forever. Your patience is your superpower. Use it without fear. You now know what most never learn. But there's one final secret. It's not about money. It's about freedom. Subscribe to Future Mint Finance. Next video. How to live off your investment.